Stocks pulled back a little bit today. Didn't get a whole lot of follow through from yesterday's big move, big bounce higher. We expected that a little bit, so I'm going to break down today's move. I'm going to break down this idea that how bullish we are from an economic indicator standpoint, and whether or not the bond market and the currency market agrees with what we're seeing in the economic indicators. So I'm gonna talk about that, the impact that has. And today's trade idea focuses in that media area where there was some news, some big moves, and how we can be able to make a bullish trade on the stock that's on a pretty good downward trend. How we can do that, and able to mitigate our risk. Let's go ahead and get started. Today is Friday, November the 17th, 2017. My name is David Settle. This is my market outlook for today. Thank you for watching. Welcome to those that found us that are watching for the first time. Welcome back to those that have rediscovered my videos here. Subscribe to this YouTube channel. Hit that red button that's just below the video. Also, hit the thumbs up. Like this video. Let me know that you found it useful with one easy click. Scroll further down, comment on today's video, let me know anything that stood out to you. In the description, there are two links. One to join a daily email newsletter. The second to fill out a survey for us. Let us know what you think. Follow me on Twitter. My handle is @DavidSettle42. While you're there, scroll up to the very top of my timeline. You'll see I have pinned to the top today's market forecast tweet. Like and retweet that so that you can promote it. Let other people know they should check it out too. All right, one more quick thing about the survey. Again, we're looking to start a new business together, Brandon Van Zee and I. We want your input. Those of you who are interested in joining us, tell us what you want. Tell us what you want to see. Scroll down, fill in all these questions, and of course, those that help us, that fill this out and let us know, that help us get going here, who are interested in joining us. We want to give you a unique offer that's special to you for helping us get going, get started. And that unique offer will go out to anybody who put their email address in this last question. So make sure you fill this out. And make sure also that you put in your name and your email address so we know who to send that offer out to. And that we're almost done. We're only less than 50 surveys away from finishing the survey, which means basically we only have a few more days left. So sometime over the weekend, if you got a few minutes, it's 8 questions. Take the time. Let us know what you think. We really value your input on this. All right, well, let's take a look at the S&P 500 with the market forecast indicator. You can see that we have a little bit of a Harami pattern developing here. So like I said before, we've had multiple days probably pulled forward into today. So a little bit of a pullback, but a very small range, very light volumes as you'll see today. So don't read a whole lot of into this pullback either, as in like, oh man, this is really bearish. It is weakly bearish because the intermediate posture is still headed lower. The near-term line still setting up for the possibility of a bearish high point, which is, for those that are new, on the blue line here, any high between 50 and 80 that corresponds to a lower high on the chart. So here's this last near-term run where the blue line was above 50 all this time and then finally crossed below 50. So there's that near-term run. There's the highest point. So there's that near-term. So I mark all the near-term peaks with these ovals. And so right now that would be a lower high point, and the near-term line would be between 50 and 80. Obviously, we'd have to come back down. So it's still just potential. And as most of you know, potential just means you haven't done anything yet. So there's the potential of a bearish near-term high. You can see the momentum line dipped its toe underneath into the lower reversal zone, but nothing too major. Still, I mean, we had a drop, an extreme low here on the momentum line. It kind of led to our most bearish, some of the most bearish move we had. That we bought the dip eventually at that low point, but that wasn't bearish enough to get us to change the trend. In fact, it was just a near-term low point that we bounced off of, with a nice long lower shadow there. But like I said before, yes, we're getting a near-term bounce here. No, I don't think we're going to bounce up to significant new highs like this. And we might go up slightly, but we're going to muddle around to do that, especially with the holiday week, shortened week. A lot of probably not a whole lot of volume next week either. Heading into the holiday. off on Thursday, half day on Friday. Usually one of the slowest periods. That this week, or excuse me, next week, and the week of Christmas to New Year's, two of the slowest weeks that there are in the markets. Barring any news events, right? But in terms of this scheduled news, scheduled earnings, scheduled moves in the market, so to speak, there's tend to be really, really quiet. Small volume, small ranges, all that jazz. So we'll muddle around here. We might get up to new slightly higher highs. Whether we do or not doesn't change anything, right? We're still in this weak bearish posture that eventually, as we grind here sideways, things will, we'll end up with eventually we'll end up with a more extended bearish run that will get it below 50 because of how long we've been above 50. Headed now for 3 months here, over past 2 month mark and headed towards 3. So we'll take a look at the Russell 2000. Let's see where we're at. Oh, over here, Russell 2000. All right, and then on the Russell, a little bit more bullish. Yesterday was more bullish too. Remember, this bounce has been tax reform related, right? The passing in the House, question marks about whether it'll pass in the Senate. So, grain of salt, and you can see we're barely just now getting to the reversal zone here. To the moving average, but it is a bullish posture. It's a weak bullish posture because it's so low. And the near-term line did get up into the reversal zone, so that's not a bullish, bearish high. That's bullish when it gets up there, and you can see it hasn't. This whole time we had that little run, but during this whole time, all these near-term peaks were, lower and lower and lower. And here's your last near-term peak, the one right here, getting above 50. Then we drop back below 50. So right there on the 13th, there's our last near-term peak, and we're obviously clearly above that. So a little bit more bullish on the Russell 2000. We know why. Again, I don't necessarily think that that's going to lead the broader market higher too, because the broader market hasn't come down like the Russell 2000 has over this past month. And the broader market hasn't brought its intermediate line down below the chart's midpoint either to establish a new intermediate opportunity. All right, from a long-term view, so we had 2 down weeks in a row. I mean, look at that streak. That's just horrible. There's your bear market right there. That's about as bearish as we've gotten here lately. Again, we're coming off an 8-week winning streak. So have 2 weeks in a row that just, doesn't even get below that 8th week's low point. Again, this shows how strongly bullish we are and just can't fight this trend. As bearish as some people may want to be, can't fight the trend. Doesn't mean that we have to, be strongly bullish in our posture. We don't have to necessarily be, at least our portfolio doesn't have to reflect, an aggressive, bullish stance. We can dial back, but we still have to be bullish, right? We still have to trade what the trend is and what's there. And then you can see again when you have small pullbacks like this, just kind of confirms just how bullish we are, and also confirms the idea that we don't tank from all-time highs. Things will get we don't see sharp big drops when the MACD is up above 100 between the 50 and 200-day moving averages. That's just not the typical pattern. It has to come down first, so it has to grind first. And now, of course, anything can happen, but according to past precedent, this doesn't happen. So, wrong chart, this one here. When you look at the 3 green arrows, again, we've been kind of hovering around that 30-day moving average, right? We dropped below the 30-day, bounced right back up above it. You see we're getting back below the 8, and that MACD, after it had bounced yesterday towards its moving average, turning back down towards 0. It's we grind down here below 0. These moving averages get closer together. Don't be surprised if we don't continue to bounce heading into Thanksgiving. It's typically a bullish week, but the moving average get flattened out, continue to move towards 0, maybe move up towards that falling moving average, but you wouldn't necessarily expect it to cross significantly above the moving average. If anything, it'd be something like this, like we see right here. Stochastics falling. I remember the intermediate line is very similar to that stochastics. Stochastics is almost below 50. The intermediate line is not as close, right? So it kind of shows, the sellers, the buyers are not nearly in control as they used to be. Now, The sellers aren't either, because we're not getting close. We're not closing at the lows of the day. In fact, we haven't really ever closed at the lows of the day on any, and that's what brings the stochastics down to the lower half of the chart. Is when you're closing in the lower, in the lower half of the range, day after day after day, and we're not, right? So again, just reflection of how strong the posture is, and a confirmation that, for things to turn around, they have to get less bullish first before they get and get weakly bearish first before it starts to pile up on each other. And it will pile up fast, because fear is a much stronger emotion than greed is. So it will pile up, and it will accelerate, but it doesn't start. It's not like the new Tesla Roadster that can get from 0 to 100 like in a nanosecond. It's more like, my first car when I was 16. My dad's old Crown Victoria that took, like 5 minutes to get from 0 to 20 miles an hour. So that's what generally happens when we are this strongly bullish. You can see just how tight the range was today. The high was early, the low was at the end of the day. So it's like, oh, we closed the lows, but come on, like not even what was that, a half a point, a little bit more than half a point. Now we have to add in the gap here. So we closed 258.61 yesterday, and we got about a quarter of a point, maybe not even that really, but we'll say it did. And so you're looking at about a full point of trading range, including the gap. All within yesterday's range. So very, very neutral candle when you look at it that way. Volume volume started off small. It finished today pretty strong. So a little bit above average volume on the light day. When you put it in context here, volume's above the line. The trading range wasn't, so it came down a little bit, and you can see it goes up and down. It doesn't go straight up, doesn't go straight down. So a quiet day, but not necessarily with quiet volume. So, a lot of back and forth going on between the bulls and the bears today, trying to figure out, how bullish we are. And you can see that the bears weren't letting the bulls take off again. They're kind of keeping it in that area, something to keep our eyes on. Again, you can also see too, the volatility index is not dropping like it has in the past, where it really starts to drop after these spikes. It's not really dropping sharply. So another one of those ideas that, we're getting some short-term bullishness, but not to the extent where it's like, okay, now we're going to be bullish for a while and volatility is going to be really low. The ratio of VIX to VXV is not getting to low extremes either. Remember, the extreme is at 80%. So if it gets back below 80%, volatility gets back below 11, we'll probably just kind of grind even higher for a while. Who knows, right? Trump trade, fiscal policies, maybe there's some good news from the Senate in regards to the tax reform, even though that's not as expected right now. But that would be the macro picture that would facilitate this trend continuing higher up to new highs for an extended period of time. Otherwise, what we're seeing, the technical is saying, okay, there's some short-term improvement, but not improvement enough to say we're back on that bullish train, especially considering how mature the intermediate posture already is, and also how high market sentiment already is. With those two factors, we just cannot expect a good, strong run starting right now. Off of this near-term low point we just created. We kind of have to muddle around here until we get that intermediate line down further, and hopefully get the market sentiment line a little bit down too, so it can give us a better launching pad than what we have right now. All right, from what's driving the market today, of course, the biggest news that drove the market is, the tax reform bill passing and the likelihood that it could pass in the Senate as well, or at least their version of it, and then they can get together and put something together that will pass in both. So, there's, that's what's driving the market yesterday and a little bit more into today. The housing starts came out today. They were insanely awesome, and you can see blew away the estimates. One of the stronger numbers that we've had in a while, and so that pushed the economic surprise index up to up above 50, up to what is highest levels that we've had in years. Like, I mean, yeah, we got here on the Trump, right after the Trump election, right? All the sentiment was so bullish and it rose up there. Well, aside from that, we haven't been this strongly bullish since QE3 started. QE3 started back here at the end of 2013. And then, of course, QE3, was going all the way through 2013. That was when QE3 ended. So it hasn't been this high since QE3 ended. And then, of course, it started to taper throughout 2014, ended over here. And you can see it was, not so good after we ended. Then the election came. We're back to positive again. Yeah, this year we've had some, but it didn't affect the stock market, right? The stock market affected bonds a little bit, but didn't affect the stock market. Stock market stayed bullish, and we're right back to it. So that's impacting interest rate hike expectations. The purple line is we won't get any more after December. The red line is one more after December, and then the gray line is here that's rising is two more after December. So most likely one in March and then one again in June. So you can see the odds of getting two more after December's hike, next month's expected hike, is actually almost higher than the odds that we won't get any at all. So putting those two together, the odds of at least getting one are starting to get pretty high, almost 80% odds that we'll get at least one, because things are looking so good, and the higher numbers continue to keep GDP estimates pretty high too. So when you look at how that's impacted the different asset classes, again, this is just today. Then we'll zoom out on the week that was. Energy jumped back up. That's up to above 2.4% gain. Remember how it wasn't very volatile? This is more the expectation. But you notice here, despite the higher rate hike odds, the dollar didn't go up. And you also notice at the start of the day, again today, when we were down just a little bit, international developed markets, not emerging, developed markets started the day down. So when we started the day, it was pretty much a risk-off move. You had, aside from emerging markets, which benefits from the crude oil, from the strong move in crude oil. So crude oil started strong. That benefits emerging markets. Gold and treasuries were outpacing everything but crude oil. So again, there's that safety trade. The dollar wasn't there though, so you can see kind of how this dollar weakness. And then by the end of the day, all these other asset classes, in fact, gold kept going up because the dollar stayed weak. Developed markets stayed weak. The S&P 500 stayed weak, which is more international based. The small cap stocks took off in the middle of the day. Again, tax reform related, right? But not necessarily kind of a risk-on move broadly, because Treasury stayed up. If the bond market was really focused on interest rate hike expectations, bond yields would have gone up, and prices, which is what this ETF measures, would be down. So you can see how the actual bond market still isn't necessarily all too bought into this this strong move and all these economic indicators and interest rate hike expectations and economic growth expectations. Here's the 10-year note yield, and you can see that head and shoulders is still in play. And that head and shoulders is the bearish pattern, and you would expect it to come down by the gap here between this, whatever trend line you draw here connecting these lows. You take the move from that trend line to this high, which is about 1.25 points. So once we cross below that line, so you're looking at about 21.5 move, maybe at 21.75. Would be a target for any reversal in yields. And again, that's not, you saw how on the economic surprise index we had the big drop in economic indicators throughout most of 2017. Well, that's what it did to yields. We were at 2.6%. We dropped all the way down to almost 2%. Now we've rallied since because the economic surprise index has rallied, but we're at the highest level it's been. This is it's interesting if you take a look at that index again. Come over here. So we're high as we were at the end of the Trump trade, right? And if you look, at the end of the Trump trade, we were up at 2.6%. The initial Trump trade, the initial, Make America Great Again trade. So once he got elected, A lot of bullish sentiment in terms of what could get done with the Republican Congress as well, in terms of fiscal reforms. Whether you agree with them politically or not, the market was positive about it. And so bond yields rallied, but then that was the peak. Economic indicators came down throughout the year, so did yields. And now we bounced back up, but even though the economic surprise index has gotten up to the same levels, we haven't. The yields haven't. They haven't gotten up to 2.6%. 2.4.5 is as close as we got, and already showing a bearish reversal pattern. If I look at the week that was, you can see bonds actually had the best performance of the week, up 1.75%. Gold up 1.5%. Interesting that you had these two safe haven trades, and then you also have the two riskiest asset classes up too: emerging markets and small caps up 1.25%, and everything else high yield kind of matching small caps. Now look, a lot of that came here this week. Emerging markets and small caps really took off here on Thursday and Friday. Otherwise, before that, it was bonds were really killing it for the week, and energy was down too, and it rallied today. And the worst performer on the week is the dollar, which again, if you're in this environment where we're so strongly bullish from an economic standpoint, that should be bullish for the currency, and it should be bullish for yields, bond yields. And you see, as bullish as that economic surprise index is, yields had the worst performance among all these asset classes, because that's bond prices, and the dollar had the worst, and you'd expect it to be the opposite. From a sector rotation standpoint, you can see consumer discretionary, again, this idea that the retail sector had a really good week, finishing off with Nike. Nike had a strong day today. Some media stocks also had strong days today. But you can also see, too, you have staples and utilities were also two outperformers for the week. So still, this safe haven, market still kind of not trusting too much in terms of how bullish we are. You look at the economic surprise index, you look, at the long-term trend. We should be as bullish as we are. But you have a lot of people saying, well, we're not quite so sure, at least in the short term, how bullish we're going to be. So we're going to start to rotate into things that hold value rather than really gain value, things that hold value better. And that's where these areas come in. And of course, like I said, discretionary because of earnings and news. Today, in the media stocks, it was the news. It was a Comcast was looking to potentially buy Fox's assets that Disney wasn't going for. So that's a possibility there. On the other end of the spectrum, healthcare just continues to really struggle and underperform. This whole healthcare reform thing is impacting that sector. You can see real estate lagging behind. Despite the fact that yields had a bad week, real estate didn't benefit, and despite the fact that we had strong housing starts. You can kind of see, and again, real estate's at kind of a leading sector from an economic standpoint. It will roll over first before the broader economy will roll over. So we want to stay tuned to how it performs relative to the broad market over a more extended period of time. If I were to go back out to 3 months, this is just 1 week, and 1 week doesn't define a trend, right? If I were to go back to 3 months, you can see it's been lagging behind, but so have all these other safe havens. As soon as, staples and utilities kind of hit their low point, right about in this area, and really started to take off here, real estate took off too, and it's been lagging just recently. So it needs to lag more to really start to show some underperformance, which would lead us to be a little bit less bullish and more cautious broadly. On the flip side, energy stocks had a bad week, and they rebounded a little today, but you can see it was more kind of like an oversold week that we bounced today and got some of that back heading into a weekend. Not necessarily, we're back to being bullish on that sector. It's more of, man, we've had a really bad week, and let's just in case, let's lock some of that in, and otherwise you would see more of a gain. But that's just locking in some of those bearish profits for this really bad week in that area, partly because of just how bearish crude oil itself has been. So we'll look at Viacom in that media industry. So it's not actually engaged in these rumors and speculation about purchasing. That was Comcast, obviously, but it's in there, right? It's within that. It's within that sector, and you can see this stock has just been pummeled over the course of this whole year. It's been on a steady downward trend, and then its earnings was abysmal. Here. In fact, it's had 3 bad earnings reports in a row, from at least according to what the markets. But what's different from this earnings compared to others, where we really dropped sharply, is this one we started down below 22.5 and then rallied and closed near the high of the day yesterday. And then with today's news, rallied us through the moving average with strong volume, intermediate line moving up with that momentum line spiking up to the upper. You can see the market sentiment's down below 20. So there's opportunity here, for kind of a more extended long-term move. You can see from a long-term perspective, you got a long lower shadow, right? Remember how bullish long lower shadows are. They tend to lead to upside moves. But again, we're below the 50. We're kind of at the 50-day moving average. It's a steady downward trend. So we don't want to say, okay, well, let's just load up on calls. We don't have to. We can, because of how cheap the stock is, we can sell a put. Right now, we have to kind of fiddle around with the price and see what price we end up getting, whether it's 110 or anywhere between 110 and 125. But it doesn't sound like a lot. But remember, we don't have to get a whole lot, even with the commissions of this paper money account, the credit, and then you divide it by the buying power effect of $415. That's how much cash you would need to get according to this account, how much cash you would need to get into that trade. That's about a 25% return until that January expiration date. That's not a bad return, locking in that buy price at 25. Now, to kind of give you some idea, because this is a short put and not say a put vertical, because you got a wide spread, you put another strike on there, now you got 2 wide spreads. It makes the vertical spread just insane. So that's why we're just looking at just selling and not doing both. But you can see, for us to get to the point for the stock to lose on expiration as much as we're trying to get, that $110, we'd have to drop all the way down to 2280. Just to kind of give you an idea of where that's on the chart, 2280 is right about there. So essentially, we'd have to reverse this whole breakout move that we've had. Number one. Number two, for us to lose that whole maximum loss, which is what the this 25% return is based on, for us to get all the way down to there, we'd have to come all the way down $450 to that level, 1934. So again, that's way down. So things that really have to fall off the rails, and of course we'd probably get out. If we were to get back down below that low again, then this breakout didn't occur. So we'd get out at that point and take a $110 loss, which a 1-to-1 return to risk ratio for a potential of 25% reward, not so bad. Not at least, and the 1-to-1 ratio, with what would be a 70% chance of success. So let's see what was that at, right? 110. Oh, on the green, sorry. 110. So right there, 2280. They had a 72% chance of success to get a 1-to-1 reward to risk ratio. That's not too bad odds. So again, we don't want to buy something that's in a steady downward trend. It is showing some potential. We don't want to do a vertical spread because it increases the odds of a maximum loss, which we don't want. And the spreads get way too wide when you have 2 wide spreads. So we're just going to sell a put, and we can do it on margin or we can do it on cash. Either way, the return gets less on cash, but we can do it on margin. And then you can see if I did it on if the same thing would apply if I did it without margin. I'd still have to get down to that level to get to $110 loss, but without margin, and it would still the same drop to price 1934 to get down to that $450 the margin account. But if I were to do it without it, you can see that it would take the maximum loss 2390. So if I were to punch the numbers on that one, 102.30 divided by 2390, That's a almost 5% return. So much smaller return. The same levels in the stock apply in terms of where you lose 100, where you lose 450. So you still have a 70% chance of getting a 1-to-1 ratio, but you have to put more cash in. Whereas with a margin account, you only need to put in $400 versus $2,390. So to summarize, the markets are heading into a holiday week. It was a quiet week, a quiet day today. That should reflect or kind of be a precursor of what we'll see next week, most likely. Barring any unexpected news, the market's not pricing in. Should be a quiet week heading into Thanksgiving as is normal. So expect, the market to, and this is kind of a bullish time of year, so expect the market to kind of grind a little bit, maybe even grind a little bit higher, maybe even the new all-time highs, but it doesn't change the fact that we're very mature in our trends, and at some point in time, they will turn around, and so we need to be very careful, very picky about what we look for. So we found something today that's already kind of beaten up. It's got a good margin of safety, and we look for an opportunity to do a kind of a good reward to risk ratio that gives us a pretty decent probability of success to take advantage of that trade. So again, thank you very much for watching tonight. I appreciate it as always. Remember to like, comment, subscribe. Hope you all have a great holiday or a great weekend ahead of the holiday. We're getting a ton of snow here, so hopefully it's not so bad where you're at. Have a good one, everyone. We'll see you all on Monday.